Welcome to our Advanced Trading Concepts series. Today, we're delving into quantitative analysis, a critical discipline in the world of finance. This approach uses mathematical and statistical models to understand and predict market behavior, supporting investment and trading decisions. Quantitative analysis is at the intersection of finance, mathematics, and computer science. It involves the rigorous analysis of financial data to identify patterns, test hypotheses, and develop strategies for trading and investment. The foundation of quantitative analysis lies in statistical methods and data analysis techniques. Analysts use these tools to create financial models that can predict market movements, assess risk, and identify profitable opportunities. In quantitative trading, strategies range from algorithmic and high-frequency trading to statistical arbitrage. These models rely on historical data and mathematical patterns to automate trading decisions, often executing trades at speeds and volumes unattainable by human traders. For example, a quantitative model might analyze historical currency data to identify arbitrage opportunities, executing trades that exploit small price differences across different markets. In recent years, the role of big data and machine learning in quantitative analysis has grown exponentially. These technologies allow for the analysis of vast datasets, uncovering insights that were previously inaccessible, and refining predictive models for greater accuracy. For instance, machine learning algorithms can analyze market sentiment data from news articles and social media, providing traders with insights into market trends and investor behavior. Risk management is another area where quantitative analysis plays a vital role. Quantitative models are used to assess and mitigate various types of financial risks, including market risk, credit risk, and operational risk. These models can simulate different market scenarios, helping institutions understand potential vulnerabilities in their portfolios during stress events. However, quantitative analysis is not without its challenges. Issues such as model accuracy, overfitting, and reliance on historical data can impact the effectiveness of quantitative strategies. Moreover, ethical considerations around automated trading and market impact are increasingly coming to the forefront. In conclusion, quantitative analysis is a powerful tool in modern finance, offering sophisticated methods for trading, investment, and risk management. As technology advances, the field is likely to become even more integral to financial market operations. Exciting topics await in our Advanced Trading Concepts series. Join us as we deepen your insights into the financial markets. Thank you for watching. Don't forget to subscribe to our channel and hit the bell icon so you never miss an update.